All right, let's talk about a financial tool that gets a ton of questions and, honestly, a lot of side-eye: the reverse mortgage. It's one of those things that people have really strong opinions about. For some, it's the key to a comfortable retirement. For others, it's a trap. So what's the real story? Let's demystify it together. So here's the big question for a lot of folks heading into retirement. Your home is probably your biggest asset, right? You've spent decades paying it off, building all that equity. But here's the catch. That value is locked up inside the walls of your house. It's great on paper, but you can't use it to pay for medical bills or, just enjoy your life. So how do you get that money out without having to sell up and move? And that question leads us directly to a really common problem, a classic retirement dilemma. You've probably heard the term house rich, cash poor, and this is exactly what it means. Your net worth looks fantastic because of your home's value, but your bank account, not so much. You don't have that liquid cash for day-to-day living. And it's this exact situation that really created the need for a financial product that could bridge that gap, something to turn that home equity back into cash. So what is this solution? Well, like the title says, it's basically a mortgage, but in reverse. Let's dig into what that actually means. Okay, so the main player in this space is called a home equity conversion mortgage, or HECM for short. Now, the most important part of this whole definition is that little phrase, federally insured. This isn't some shady back alley loan, it's backed by the FHA. The whole point is to let homeowners who are 62 or older tap into their equity without, and this is the kicker, without having to make monthly mortgage payments. This chart just lays it out so perfectly. Think about your regular mortgage. Every month, you write a check to the bank. Your loan balance goes down, and the amount of the home you actually own, your equity, goes up. A reverse mortgage completely flips that on its head. The lender pays you, and because they're paying you, your loan balance goes up over time, which means your equity goes down. The whole flow of money is, well, reversed. Now, this is super important. This is not free money. It's a loan. And just like any other loan, it comes with some pretty significant costs. So you have to know what you're getting into. Let's break those down. Okay, let's be real. The costs can be pretty hefty. You've got origination fees, appraisal fees, title searches, all the usual closing costs. But on top of that, there's a big one, mortgage insurance, both an upfront premium and an annual one. Now, the tricky part is you don't usually pay for this stuff with cash. Nope, it gets rolled right into your loan balance. So while that makes it easier to get started, it also means your debt grows faster and starts eating into your home's equity right from day one. This is really where the conversation gets interesting. Reverse mortgages have a, let's say, complicated reputation, but a lot of that is based on how these loans worked years ago. We really need to separate the old myths from the new reality. I saw this quote, and it just hits the nail on the head. So many of the horror stories you hear are from a completely different era of reverse mortgages, before major government reforms. The rules have been rewritten. They've added a ton of consumer protections that make the modern HECM, as the quote says, a very different animal indeed. Okay, if there's one thing you take away about protections, let it be this. It's called a non-recourse loan. And this is a huge, huge deal. It's a legal guarantee that says if your loan balance ever grows to be more than what your house is worth, maybe because of a housing market crash, neither you nor your family will ever be on the hook for that extra amount. The FHA insurance fund pays the difference. It completely eliminates that nightmare scenario of passing a huge debt onto your kids. But, and this is a big but, it is not all smooth sailing. There are some serious pitfalls you absolutely have to know about. This is not a set it and forget it kind of deal. You, the homeowner, are still responsible for paying property taxes and homeowner's insurance. If you fall behind, the lender can call the loan due and even foreclose. You also have to actually live in the house. And, of course, the loan has to be paid back when you pass away, which usually means selling the home and reducing what your heirs get. So, after hearing all the pros and cons, the protections and the pitfalls, how in the world do you decide if this is the right move for you? This is kind of like your personal checklist. On one side, we have the "this might be a good fit" column. You're planning to stay put for the long haul, you can easily cover taxes and insurance, and your main goal is just to have more cash to live on in retirement. But on the other side, if you think you might move soon, or if paying for upkeep is already a struggle, or if your number one goal is to pass your home down to your kids free and clear, then you should probably steer clear. And when you boil it all down, it really comes back to this one fundamental question you have to ask yourself. What is this house for at this stage of your life? Is it a legacy, a nest egg you built for the next generation? Or is it your final financial resource to fund your own health, your own comfort, and your own independence in your retirement years? There is absolutely no right or wrong answer here, but knowing your answer, that'll tell you almost everything you need to know.